Hello everyone. I hope you're doing good, mentally and physically fit and fine, friends. So, friends, we have covered lots and lots of good questions, lovely questions, beautiful questions, conceptually drafted. We have seen the crux points, we have seen the answers also. What are the key points of the answers and how to remember them? Just go through them on regular basis. You should do cumulative revision of 2 to 3 days and cumulative overview from start. Okay, so cumulative revision means, okay, you are recollecting each and every point for 2 days, of 2 days on daily basis. And cumulative overview means you are just going through the headings of the all the questions right from the beginning, right from the start. Okay guys, now today let's go to the chapter number 5 and we'll try to go through chapter number 6 also. Chapter number 5 and chapter number 6. So that's going to be very interesting, guys. And these chapters, are going to contribute to good questions. Okay, and these are going to be comparatively, I would say that they are going to be comparatively on the easier side. Guys, as said earlier, I expect two things from you: like, subscribe, share these videos, share with everyone. It gives us a lot of happiness, and your comments. And your comments, once the video ends on the comment section, that is definitely a superb feeling, superb level of satisfaction. Do keep commenting, and it's overall about the class, about the studies, and everything. We really appreciate it. Okay, guys. So let's start with chapter number 5, and the first question is, here is the first question. It's a very famous question, has been it's a very famous question, has been asked a lot of times. Let's see, guys. So it is about the management expert. We know that expert are of two types. If they're appointed by the management, appointment by the management to help them in the accounting process, management expert. And if they're appointed by the auditor, he's auditor's expert. Now, how to deal with management expert is given as a 500 because his report is one of the audit evidences. Is given as a 500. And how to deal with the auditor's expert is given as a 620. So here the question is very simple, that management is using the expert, and the question is, can we rely on him? Can we rely on him? Can we rely on him, on his findings? Can we rely on his report? Okay, that is the first way of asking the question. That is the first way of asking question. One more very important. Now now this is very important, and that's why understanding questions, interpretation of the questions is very important, guys. In the second question, they simply say that, you see that there's an actuary. There's an actuary, and he's computing, he's doing valuation. He's doing valuation, and the retirement age adopted is 65 years against the existing 60 years. So basically, there's an actuary. And he is using the retirement age of 65, but the earlier retirement age was 60. And comment. Now they are not saying anything about the evaluation of the work of expert, about the relying on expert. Nothing. They're simply saying that one of the data which he's using is different. Comment. We have to write that we have to evaluate the work of expert. So I will say that this is a star question, because you have to think about it. You have to think about it, what to write. Okay, you have to think about it, guys, what to write. Let's see, guys. Then one more way of asking it is that the report prepared by the actuary is faulty. Comment on it. Report prepared by the actuary is faulty. Comment on it. Again, that means we have to evaluate the work. We have to evaluate the work of the actuary. See, these are the different ways of asking. I have been instructing you. I have been explaining it to you that it's very important to read the questions. To read questions is extremely important. Read all the questions 3 times, 4 times. That why they give this particular answer. Okay, this is the type of the question. This is how I'm supposed to go. in last they clearly say about evaluating the work of actuary. Now it's pretty simple, guys. We have to talk about three steps. Okay, summary is given. You can remember those summary points and then write in your own way. First thing is, we are supposed to evaluate competence, capability and objectivity of the management expert. Competence is knowledge and skills. Capability is ability to deliver in the given circumstances. That means time, team, equipment and communication skills which are required there. And objectivity means being unbiased, not working being unbiased, neutral, and not working under any pressure or not working under any conflict of interest for personal benefit. Objectivity. So we have step number one is evaluate competence, capability and objectivity. Step number two is we need to understand important principles and methods used in the field of expert. So next step number two is understanding the field of the expert. Understand the field of expert, understand what kind of methodologies, what kind of softwares, what kind of theory, what kind of approach they adopt, how they do the calculation, understand it, and finally evaluate appropriateness of the work of expert. So you are going to focus on three steps first. Okay, then you are supposed to write one by one about each step. About each step. So let's talk about competence, capability and objectivity. Summary is given. If you want to know about the competence, capability and objectivity, it's pretty simple. Okay, first go and ask, what are the qualifications? So go and look into two documents. What are the qualifications of the expert? How many degrees he has taken, from where he has taken degree, what is the value, what is the reputation of that degree. So go and see the qualifications, and then how many research papers and books he has written. So go and see these documents. Then next is experience. Go and recollect if we have any personal experience of working with him. If there is no personal experience, go and discuss and ask questions. Go and sit across the table or talk to other experts who are familiar with this particular expert. So it's pretty simple. If you want to know about CCO, go and see two documents, and 3 points are related to experience. Recall your past experience, or just go and discuss. If it's not there, go and discuss things without him, or simply talk to other expert. Then understanding the field of expert is very important. Understanding what kind of methods, formulas, softwares, approach is adopted, and how calculations are done. Go and understand the field of expert. Understand the positive pros and cons and the issues and challenges. That is step number 2, guys. Okay, this is step number 1, step number 2, and finally step number 3. It is pretty simple. We have already seen this, guys. In any expert, suppose we have an actuary and who is computing provision for gratuity. So what kind of data is going to need? We have to go and look at the source of data, whether data is complete, whether data is accurate, whether data is relevant. That means suitable out here. So what do you mean by that? Pretty simple, guys. So whether number of employees are complete, whether number of employees are complete, whether data of employees is accurate. So whether number of employees, their qualifications, their age, their present salary, what is the retirement age. So data is complete. Then we have to go and need to check the data. Is it complete? Is it accurate? And is it suitable? We need current year's data, latest data. Then next actually needs is assumptions. And then he puts data and assumptions in methods. So we need to go and understand whether these assumptions and methods are again suitable, relevant and reasonable. So whether these assumptions and methods are good for this industry, good in this particular circumstances of growth or decline, whatever it is, good for the industry, good for the circumstances, is it suitable? Then go and match it. Is it in line with what industries, what it is happening in the industry? It is in line with what financial reporting framework says, whether it is in line with what management says, whether assumptions and methods are in line. Then go and see about the findings and conclusions, whether findings and conclusions are relevant. Is it covering everything which we wanted, in balance sheet and P&L? Is it giving us relevant data? And whether it is reasonable. Plus minus 5% change is absolutely fine. It is reasonable. So guys, we have to talk about 3 steps. We have to talk about CCO, how to get this CCO. We will talk about obtaining understanding of the field of the expert. And the last is evaluation. In evaluation, we talk about data, we talk about assumptions, we talk about methods, and then reports and conclusion. And we get a beautiful, lovely answer for this. So guys, what a beautiful, then the way they asked, the way they drafted, few of the questions was absolutely fine. A very important note is given: if question is silent, whether the expert is management expert or the auditor's expert, always assume the expert is a management expert and answer as per SA 500. That is what they have done. Okay guys, let's see. Next. So next is November 23 RTP. Very interesting guys. It is coming from November 23 RTP. Okay. And they have targeted something. They have targeted something which is not there anywhere. I won't say it is difficult, but they are targeting a new point altogether in the field of expert. Okay, in the field of expert. So what is it all about? So they talk about a company. They talk about a CA firm. Okay, and the company is appointing same management expert year on year on continuous basis. Year on year on continuous basis. Okay. Now, same person is repeated again. So it is a long association with the company. So should we evaluate objectivity? That's the question. And the two team members are discussing about it, are having different opinion about it. Okay. For last 5 years, management has been reappointing Mr. Sheetal as the expert for computing environmental liabilities. So company has established an oil well or a plant, whatever it is, and expert is appointed for computing environmental liabilities and how much provision should be prepared for it. So now, so Mr. Shreyans from the CA firm feel that we have nothing to do. It is management expert. We have nothing to do about it. Why to think much about it? It's management expert. We should not question it. Okay. But audit partner feels we should definitely go and evaluate objectivity. So a team member says that the person is management expert. We have nothing to do about him. It's okay if they're appointing their expert. Fine. But audit partner says that we have to evaluate the objectivity irrespective of the fact that he was appointed as independent expert. So who is correct? We are supposed to talk about it, guys. So the answer is pretty simple. Yeah, definitely, guys. So answer is pretty simple. Answer is pretty simple and straightforward. Okay, that we have to evaluate objectivity. For sure, we have to evaluate objectivity. But then you are not going to get marks for only that. Okay, so let's understand, guys, what we are supposed to write. First, give reference of SA 500. Give reference of SA 500. that the person is appointed by the management is management expert, and we have to evaluate his work as per the principles of SA 500. Give SA 500 its full name and one line about it, and then you're supposed to say, write that yes, we have to, if we are planning to rely on his work, we have to follow 3 steps, and write about those 3 steps we have just discussed. CCO, understanding the field and evaluating the work, and then you say that one of the important principle is objectivity. One of the important principle is objectivity. It clearly says that if we want to rely on his work, we have to go and evaluate the objectivity. Objectivity means whether the person is going to be unbiased, not getting influenced by the personal dislikings, and he will not work under any pressure, undue pressure, and next, he is not going to work under conflict of interest for personal benefit. Objectivity. So now, and from here they are writing more things. So as an auditor, we are supposed to see whether there are any threats, and we have to write all the threats. We have to write all the threats, whether there is any interest, self-interest threat. Okay, so shortcut is I am fair. You can use a shortcut. I am fair. I am fair in my approach. Okay, I am fair to all the threats. I for interest, self-interest threat, familiarity threat, advocacy threat, okay, intimidation threat, self-review threat. You're supposed to talk about threat. Yeah, yes, as a auditor, while evaluating the objectivity, we have to go and see whether any of the threats is surrounding the expert, whether expert is involved in any of the threats. Then we are supposed to see what are the safeguards. Safeguards are the steps, procedures applied to reduce the level of the threats. So safeguards can be through external sources or management expert work environment. So what do you mean by that? See, safeguards can come out of law, rules, regulations, or some professional standards. Law, rules and regulations or professional standards. There can be law, rules, regulations which say that management expert should not hold shares, management expert should not be indebted, management expert should have personal relationships. So there are external structures. So there can be policies and procedures to protect the objectivity. It can come from law, rules, regulations, or professional standards, or it can be because of management expert work environment. Management expert may have their own quality control system. Quality control system is nothing but policies and procedures of doing the work, and as per those policy and procedures, there can be conditions. This should not be there, that should not be there. Okay, then you explain that expert can be employee of the entity, or he can be outside, he can be a third party, and then you explain that definitely if the person is a third party, the level of objectivity is more. If the person is an employee, level of objectivity is comparatively less, because there is always an intimidation threat. Remuneration, bonuses, commission, facilities, everything is dependent on management. So you explain level of objectivity changes if the person is a third party, or if a person is a if a person is an employee, and there is a threat to objectivity for sure, a threat to objectivity. So we should see whether the person is an employee or a third party. We should also see relationships, interest and relationship, whether there is any personal relations are there, financial relation, business relation, or giving other services, being dependent on the entity. Finally, discuss the case out here that the person is appointed for past 5 years. Conclusion is we have to evaluate objectivity. We have to evaluate objectivity, guys. For sure, we have to evaluate objectivity. Okay, because so partner's view is correct. Audit partner's view is correct. That's the important thing. Let's freeze, guys. So this particular concept is not in the module. This is not a new concept, but then specifically for management expert, it is not in the module and generally not there in any of the notes. We have marked it as a unique. So let's freeze, guys. Okay. You have to give reference because it's a management expert. Give reference of SA 500. You talk about 3 steps. You talk about objectivity is important. You talk about for objectivity, we have to see whether there are different types of threats. We have to see about the safeguards. We talk about how being an employee or being a third party impacts the threats. We talk about interest and relationship to be evaluated. Discuss the case, and conclusion is yes, our partner's view is absolutely fine. We have to go and evaluate the objectivity. We have to see the whether the person is employee, third party relationships that need to be checked. Partner's viewpoint is absolutely fine. Again, guys, lovely question. Lovely question. November 23 RTP asked only once. Big chances it will be asked. Big chances, guys, that it will be targeted. It will be asked. Now, okay, guys, for if anyone from the north is watching this lecture, guys, this is exclusively English lectures. And these lectures specially designed for the south students. It's in full English. The same lecture we have at 11 o'clock, that is in English, Hindi and English mix. Okay, guys, let's go to the next question, guys. Let's go to the next question, and it's again very interesting, has been asked over a period of time, good number of repetitions. So the question is, there is an expert, the question is, there's a lawyer which says that company should make provision of 5 crores. Company should make provision of 5 crores for some tax liability, but actual tax liability came to 50 crores. Actual liability was different, way different. In one example, they have said that actual was 50 crores. In one, they say that lawyer estimate 3 crores, but it came out to be 5 crores. So comment. So comment about it. So basically, there's a big difference. Actual thing is big difference. The actual thing is different. Okay. So we have discussed this. If actual thing is way different, okay, there's a big inconsistency. What should be done? There's a big inconsistency. What should be done in this particular case? Okay. Now, see, guys, they are they are not exactly talking about evaluating the work. They are saying to comment on the situation. This is how this question is different from others. They are saying just to comment on the situation, that whatever was expert said and whatever actually happened, it's quite different. It is quite different. Okay, there's an inconsistency. So what? Comment on this particular situation. What will happen? So we are supposed to talk about this, guys. So very simple, pretty simple, straightforward. We first assume that it is management expert, and if the person is management expert, then his work evaluation is covered in SA 500. SA 500 will get applicable. Then you explain that it's a very common practice in variety of areas. Management take helps of expert in different areas. They take help of different types of expert, whether it is taxation or litigations or actuaries. You can give example. It's a common practice. Yes, SA 500 is applicable. It's a common practice to take help of expert by the management in different areas. Then you say that it is auditor's responsibility. It is auditor's responsibility to carefully evaluate the work of the expert. That's very important. It's evaluate the work of expert. In fact, you can write about the 3 steps. That competence, capability, objectivity, understanding the field of the expert, and finally evaluating his work. It's important. Auditor cannot blindly rely on the expert. He has to follow the procedure and then only rely on it. It's very important to be very careful before relying on the work of expert, because we can delegate the work, we can rely on the work, but we cannot delegate responsibility. Ultimately, we will be answerable if anything goes wrong. If there is a fraud or error in that, we will be answerable to people, we will be answerable to authorities. Okay, so if we are going to be responsible, so discuss the case, And then you make conclusion that because a big difference is coming up, it definitely shows that because of the big difference, it definitely shows that, definitely shows that auditor didn't evaluate the work properly before relying. It is a non-compliance by the auditor. It is a negligence by the auditor. Otherwise, how come such a big difference can arise? So, the way you draft answer, you write the assumption and give reference of SA 500. You talk about it's a common usage. You talk about the responsibility of the auditor. You discuss out the case and you say that auditor is responsible for this inconsistency, for this mismatch, such a big mismatch. That means evaluation from the auditor was not appropriate. So this is how this flavor of the question is different. We have to comment on the situation. Guys. So as it turns out, it's very interesting. It's very interesting, guys. Pretty interesting that 3 different types of questions are drafted on management expert. Evaluating the work of management expert is one thing. Evaluating objectivity is the another thing. And then commenting if there's a difference, then auditor is responsible. This is a different thing. Lovely questions, guys. The lovely questions, different types of questions, different way of answering it. Now, let's understand this, guys. So it's a new question, study material 23. There's a new question and they're talking about the audit evidence. So basically what's happening is there's a company. There's a company, guys, and this company is into exports. This company is into exports, and they're exporting their products out of India, and now they are booking revenue when bill of lading is issued. That means goods move out of the factory. They reach the port. Then goods are given to the transporter. They are given to the ship. And then the ship gives the proof that okay, that goods are received and they will be delivered at so and so destination by so and so time, so and so details are there, and you get a bill of lading. So revenue is booked only when bill of lading is issued. Okay. So is that appropriate? Now then further they are saying that in the month of March, 3 consignments have moved out of the company, but export is not yet booked because bill of lading was not yet generated. Bill of lading got generated in the next year and it was booked as export in the next year. Discuss from what sources we can obtain evidence about reliability. So whether this approach by the management is appropriate. So management is booking export on the basis of bill of lading, whether this approach is appropriate and how to evaluate these exports. Guys, it is coming from study material 23, so it becomes extremely important. You may think, oh sir, what is it? Oh, come on. Now, I have summarized the points on which we are supposed to focus on. So first, you are supposed to say that Ind AS 115 and AS 9 is applicable, which tell us when revenue should be recognized. Ind AS 115, and we have Ind AS 115 and AS 9. We have Ind AS 119 and AS 9, which tell us when revenue recognition should happen, what should be the timing of revenue recognition. Okay. Then you explain the revenue recognition principle. Revenue recognition principle says that revenue should be booked when the ownership of goods is transferred, when risk and reward of the goods are transferred. Okay. And then you explain that they are generally transferred on delivery. we have to go and read terms and conditions of the contract, to understand when ownership getting transferred, and then we have to book revenue accordingly. Okay. Now, if you assume FOB, sales contract says FOB, free on board, that means entity will simply provide goods at their godown. Customer has to come, take the goods, give it to the ship, and it will reach its destination. If we assume free on board, that means company's responsibility is simply to deliver goods at the factory. At factory, they will give the goods, deliver the goods, and then they have to take out and then take out of the India, and so on. Okay. So if we assume free on board, I hope you are aware, free on board is a very simple thing. That means contract says that make goods available at your factory. From there, customer will do rest of the things. Then revenue should be booked when goods move out of the factory. Revenue should be booked. We have to take assumptions in such a manner. That there is a default. Something has went wrong. Then only case study will make sense. Otherwise it won't make sense. So we assume that if it's a free on board contract, then ownership gets transferred at the factory gates, and revenue should be booked as soon as goods are out of the factory gates. Okay, and not bill of lading. So they are doing a terrible mistake. Of booking revenue at bill of lading. Management is going wrong. You explain what is bill of lading. Bill of lading is a document which is given by the transporter as a proof that they have received so and so goods, description, quantity, destination, and this is the expected time it's going to reach the destination. And this bill of lading is going to be ownership proof. Whoever is having bill of lading can take custody of the goods. Okay. So you explain that revenue recognition by the company is not appropriate. So these points are focusing on revenue recognition. And the final answer is revenue recognition by the company is not proper. They are booking delayed revenue. And because of that, some of the revenue will be missed. There will be problem with completeness. Then that's what is happening in the month of March. There are 3 exports. They are booked in April. It is getting delayed. They are booking it late. It is affecting completeness. Now, then you talk about verification. How are you going to verify these export sales? Well, that's pretty simple. Simply imagine step by step what happens. You will automatically get documents from which you can verify the export sale. The first thing which must have happened is customer order. So verify it from the customer order. Next thing is approval. First thing is customer order. Next thing approval. Verify then dispatch records. Then sales invoice is prepared. Then e-way bill. So whenever there is a movement of goods, a e-way bill is prepared. That in GST return it will be there. Then refund of IGST. You can check from there also how much IGST refund is there and whether it belongs to these exports only. And finally, receipt of money. So first comes customer order, then comes approval, then comes dispatch, then comes invoice, then becomes e-way bill, then comes GST return, then comes refund, then comes receipt. We can verify from here. So you have to focus on these 2 things. It's a lovely case about the export sales. Lovely case. Okay. About the export sales, guys. We have to talk about revenue recognition where company is going completely wrong. They are going to miss revenue. There is going to be issue with the completeness. There is going to be issue. Okay, Preet said we cover all the module questions. Our Param question bank covers each and every question from the study material, and I think you have not seen the first lecture, that's why you are asking this question. We have made 350 important plus list. It is covering all the questions of study material, plus it is covering past 2 years, 4 attempts RTP, MTP, plus all the questions which are repetitive in nature, and then we delete, we delete the questions which are asked in this. We have deleted the questions asked in 6 attempts because there is a low probability that they will come, and that is how this important list is created. Okay. Now, so it is a study material question only. Is a study material question, guys. So it was lovely, guys. 3 questions were focusing on the management expert, and 1 question was focusing on the exports. Okay. Now, let's see. Now, guys, it's again lovely. Now, here it is. Physical verification is impractical. So, in first, they are saying that for some reason, it is impractical to attend physical verification. Again, in the second, they are clearly saying because of unavoidable reason, it is impractical to go for physical verification. Okay. So, first 2 cases clearly say that it is impractical. And now, there is one more way in which they have drafted it. So, management will be performing annual physical inventory count at all warehouses, okay, and management confirmed that they will be performing 100% physical count of inventory for the current period. Partner decided not to perform any physical count of the inventory as it will be duplication of the work. It will be duplication. Now this is again, as I said, guys, reading all the questions is extremely important, and reading it 2 times, 3 times is extremely important. First 2, they're clearly saying, in the first 2, they're clearly saying that it is impractical to attend physical verification, and now management is saying, now the partner is saying, if management is doing all the physical verification 100%, not to perform any physical count of the inventory as it will be duplication of work. Moreover, he decided that the written repent from management saying the inventory exists and will be sufficient appropriate with respect to audit evidence, and to conclude that inventory balance is free from any material misstatement. In light of SF 501, evaluate whether decision taken by engagement partner is appropriate or not. So basically, they are saying that management is doing everything. Why to go and perform any physical verification? Simply take their data. Okay, take their data and take written representation from them, and that will be sufficient. No need to do anything else. Answer it as per SF 501. So in this question, SF 580 written representation, even that would have been relevant. But they have clearly said that answer as per SF 501. Answer it as per SF 501. Okay. So guys, to be on safer side, we are going to write 2 things. Okay. And the first question they're asking also, how to obtain sufficient appropriate evidence regarding existence and condition of inventory, and what to do if it is impractical. Now guys, let's freeze. In SF 501, first they explain how to obtain evidence about existence and condition of the inventory, and in that they explain what to do when you attend physical verification. So they basically explain how to attend physical verification, all the points related to that. And then they explain three special cases. Can physical verification happen on different date? Case number one. What if the physical verification is impractical? Special case number two. And what if the inventory is with the third party? What if the inventory is the third party? So they cover three special cases. So guys, to be always on the safer side, what we'll do is first explain how to obtain sufficient appropriate evidence about existence. So first we'll explain how to check existence and condition of inventory. That is point A. And then we explain what if things are impractical. What if things are impractical? That is point number 2. Okay, there is point number 2. So we are supposed to do two things. Let's see guys, one by one. It's very simple and straightforward. Very simple, straightforward. Come on guys. Now, so in this we are supposed to explain, first thing, it is given in there, if inventory is material, it is auditor's responsibility, it is mandatory to attend at least one, attend at least one physical verification which is conducted by the management. So SF 501 gives simple principle. In a year, you should at least attend one physical verification which is conducted by the management. Now, what to do in this physical verification? We are supposed to perform two steps. We are supposed to perform two steps. In titanium book, we have given a mnemonic also. You can use that particular mnemonic. Okay. We have Moti reconciliation. In physical verification, what we are supposed to do? Moti reconciliation. Okay. Pearl. Moti means pearl. So Moti reconciliation. Okay. Now, if you want that, let's go to that only. Just a minute, guys. Okay, guys, let's see. Guys. Now, so if you want to go and check, so first thing is very simple, straightforward. You have to attend it. You have to attend physical verification, at least one physical verification in a year. You have to do that. Then what are you supposed to do out there? So shortcut is Moti reconciliation. First thing is management instruction. Go and see whether management has made proper arrangement. They have given proper instruction for physical verification. All locations at one time. There should be counting people. There should be people for supervision. There should be process on how to write, where to write the actual inventory, stock. So go and see whether there are proper, adequate management instructions, reliable management instructions. Then tell them, okay, go ahead, start performing physical verification. You should go and observe whether they are performing physical verification as per management's instructions. Then T stand for in between, go and perform test count on sample basis, go and perform test count and see whether your counting data and their counting data, it agrees with each other. Finally, keep inspecting. During this process, keep inspecting condition of the inventory. Is it defective? Is it obsolete? Okay, keep looking at it whether the inventory condition is appropriate. Finally, at the end, you have to perform a reconciliation that this was the actual inventory and this is the actual inventory and this is the inventory as per the records. Let's compare them, let's find out the discrepancies, differences, and then adjust them. So you need to explain, it should be done. So in one of the cases it is saying let's not do duplication. Partner's point of view is incorrect. Partner's point of view is inappropriate. Partner's point of view is inappropriate. Partner's point of view is incorrect. We are supposed to attend at least physical verification at least once. Even if management is doing it, we have to go and attend. We are not supposed to perform, but we have to go and attend and perform. This moti reconciliation is the shortcut. See guys, concepts of yesterday we didn't had lecture. So this is the direct lecture. Yesterday there was off because of the power failure, power issues were there. There was no lecture yesterday. Okay. Now guys, and this testing is going to help us in both. In test of controls, if you want to see whether the internal control system of counting is working properly, we can use it for checking internal control systems also, or we can use it for examining year-end stock also. So this technique can be used for testing controls also, and it can be used for substantiating, for substantive procedure also. Now, so this case is extremely important. It is as per new study material. It is a latest case actually, as per new study material, that contention of the partner is absolutely wrong. Team has to go and attend physical verification for sure, and just relying on written representation is not at all acceptable. It is not at all acceptable, guys. Then next we have to talk about when things are impractical. Let's see guys. So this is what we are supposed to explain. When things are impractical. If attending physical verification is impractical because of any reason, if it is impractical because of any reason, okay, then the first thing you are supposed to focus is on reason. What is the reason? Is it the nature and location of the inventory or location of the inventory? Whether the nature of the inventory is dangerous, it is leaking radiations, location is at the border area where war is happening. So first look into the reasons, guys. Then next is to look into whether there is a threat to safety. If there is a threat to safety, it's an acceptable reason for not attending physical verification. But general inconvenience is definitely not an acceptable reason. If there is a problem of DTC, difficulty, time and cost, then we have to think carefully. If alternative audit procedures with equally good persuasive evidence is available, we may avoid attending physical verification. But if alternative is not available, then we cannot avoid it. So we have to go and see whether alternative audit procedures giving equally persuasive evidence is available. If answer is yes, avoid it. If answer is no, don't avoid it. So we have to talk about the reasons first. Then we have to talk about alternative procedures. If it is impractical, go and perform alternative procedures. Or we can compare with the previous year. We can see purchase documents of the inventory, subsequent sale documents, internal auditors report, all these are alternative set of procedures and evidences. If alternative procedures doesn't give sufficient appropriate evidence, we have to modify opinion as per SS 705. We may go for qualification or disclaimer. So you are supposed to talk on three things. You are supposed to talk about the reasons first. Then you are supposed to talk about alternative audit procedures. And then you are supposed to talk about modifying the opinion. Supposed to focus on three things. Now guys, let's come back to our answer. The same thing. We are supposed to talk about reasons first, then we are supposed to talk about alternative procedures, and if it's not giving, then we are supposed to talk about the modifying opinion. Okay, modify the opinion, and we have covered all the points, guys. Now here, in this particular case, only portion A, the point A is going to be sufficient, that engagement partner's point of view is not appropriate, okay. In this, only portion B will be fine. Here both A and B will be required. If you have little doubt on as a precaution, you can always include the A portion also, about attending physical verification, and then you discuss about the impractical, and then you discuss what to do when it's impractical. So guys, lovely cases. There are three cases out here, and the way you answer it depends on each of the case. The first, we have to answer about the attending physical verification also, and we have to answer about impractical also. Second, we can directly jump to being impractical, and then this one we have to jump on the first thing, that attending physical verification is mandatory. Okay, guys, listen. In this particular session, we are going to focus on the questions. I understand. If you got any doubts, I will explain how you can ask the doubts. But then there are daily targets, guys. There are daily targets. We are supposed to achieve those targets. Already, there's a time limitation, and we have to focus on that. We cannot divert our attention. And go for the doubt clearing right now. But then I will definitely let you know how you can ask your doubts. Okay, don't worry about that. And now, so guys, lovely questions are there. Lovely questions of SF500 we have seen. Lovely questions of 501 we are seeing. Now, very interesting, guys. Very interesting. Again, a question is coming from study material 23. It was asked in November 19 RTP. Then it has now come to study material 23. Study material 23 now, guys. Okay. Let's see, guys. Study material 23. Now, I would also like to say that there is a titanium revision, guys. Titanium revision. If you want concepts, there's a titanium revision. There's a titanium revision in English also. And in that I have discussed the concepts also. Now let's see. It's very simple, that significant amount of inventory is held by third parties. As an auditor, what audit procedures you will perform? It is pretty simple, straightforward, that what to do in this particular situation. Okay, let's see, guys. We are going to see, whenever I go to titanium book, I'm simply going to concept book. Content remains same. Whatever is given here, same thing I discuss in titanium book. The only thing is, titanium book is systematically arranged. There is a flow, there is a shortcut, and some important things are highlighted. That's why I go to titanium book. You may go with the titanium book, or you may be having your concept book. That is absolutely fine. So what are we supposed to do when the inventory is with third party? What are we supposed to do when inventory is with third party? Okay, so we are supposed to do three things. Guys. Let's see one by one. If inventory is third party, in the sequence of easy to difficult, if inventory is third party, if a material inventory is third party, big portion with the third party, SF501 gets applicable. You give reference and all details, and then you say that we can do three things. Number one, the easiest one, external confirmation from the third party. We go for external confirmation from third party regarding quantity and condition of the inventory. What is the quantity of, what is the description, what is the quantity and what is the condition of the inventory? We can go for external confirmation. Then we can go for other audit procedures. We can go for other audit procedures. Okay, we'll discuss what is other audit procedures. And third, the most difficult, we ourselves go and inspect. We book tickets, take a flight, take a train, go to the location, and we count inventory. We perform physical verification of the inventory. We perform inspection of the inventory. That's going to be very difficult. Definitely a lot of efforts and resources and time will be required. And in between we have, so easiest one is external confirmation. Difficult one is perform physical verification yourself, perform inspection yourself as an auditor. Okay, if it's a very big inventory, critical inventory, we may go for it. And then we have other audit procedures. We have other audit procedure. Again, depending on circumstances, what is the amount of inventory, what is the risk involved, whether any fraud has taken place, and so on. Keeping all these things in mind, we can go for different other audit procedures. Again, the easiest one first. Easiest is just to go and inspect, just to inspect documents. Whenever inventory went to third party, there must be documents. Whenever inventory came back from third party, there must be documents. Simply go and see the documents. How much inventory was sent, how much inventory was received back, okay, or consumed, and you will automatically know what should be the closing balance of the inventory. Simply inspect document. If you want to work more, then next is get information, get confirmation, not from the third parties, from other parties. So many times when this thing happen, when inventory is given as a pledge, when inventory is given as a pledge, as a pledge to the banks or financial institutions, they keep in public warehouses. So we can directly take confirmation from the owners and managers of public warehouses. Are you having this company's stock, description, quantity and condition? So it is called confirmation from other parties, parties other than who are having the control over the inventory. Okay. Then if you want to work more, you can call for reports. You can call for reports from the third party auditors. We want report from the auditors of the third party, or we can say we want report from the service organization auditor, SO auditor. When the inventory is with the third party or service organization, we want a report from the third party auditor. They're also called another auditor or SO auditor, and we want to report that the internal control system which was followed for counting and checking condition of the inventory was adequate. So you can rely on the information given by the third party. Or if you want to work more, arrange someone to go and attend physical verification on your behalf. Arrange someone, okay, you go and do physical verification on my behalf. More efforts, you can simply go and attend physical verification whenever it is conducted. See, what is the difference? We ourselves go and do the counting. That is a different thing. And we simply attend whenever physical verification happening is a different thing. I hope you got the difference. Let's freeze, guys. If inventory is with a third party, easiest is external confirmation from third party. Difficult is go yourself and perform physical verification of the inventory. Go yourself and inspect the inventory. And now in between there are a lot of other audit procedures are possible. The easiest being go and see the documents. Then little more efforts, take external confirmation from other parties. This happens only when goods are given as a collateral. Then more, you can go for confirmation from other parties. Okay, you can go for reports from third party auditors, SO auditors. You can appoint another auditor to go and attend physical verification. You personally go and attend physical verification, and so on, guys. So it's a pretty simple, straightforward, no complications at all. No complication at all. Very high chances it will turn up in exam. Very high chances. Now, again, it's now this lovely case, beautiful case, guys. Lovely case, beautiful case. So SA 501. Just a minute, give me a second. Okay, guys, now let's see. Wonderful. In SA 501, we deal with three things. We deal with three things. We deal with inventory, litigations, we deal with inventory, we deal with litigation claims, and then we deal with the segment information. Okay. When we talk about the litigations and claims, when we talk about litigations and claims, uh, we say that first go and collect lots of information, obtain understanding about the litigation and cases. So we basically go and perform risk assessment procedure. We collect loads of information, that is in litigation claims. There's a first step, collects information about litigation and claims. Okay. If you find that there are complexities, judgments, pressures, etc. So if you find, okay, then you say that, okay, there's a risk in litigation and claims. There's a risk in litigation and claims. Then you go for step number 2, and that is called direct communication. That is called as direct communication. That is called direct communication. If there is a risk in litigation claims, we increase audit procedure, and in increasing audit procedure, we go for direct communication with the external legal counsel. We go for direct communication with the external legal counsel. That means the outside law firm which is assisting, helping the entity, if any. We go for direct communication with them. We go for letter of inquiry. We go for letter of inquiry. This letter of inquiry, guys, this letter of inquiry is drafted by auditor, but it is printed by the management. It is printed by the management on their letterhead as a approval that you can go and communicate with these guys. Then it is sent by the auditor, and reply is received directly by the auditor only. Only one step of printing it on their letterhead and approving this communication is done by the management, guys. Okay. Now in this case, in this case, they are they are saying that while collecting information, obtaining understanding about the litigation claims, they come across a very heavy legal fees of 10 lakh rupees being paid. 10 lakhs, legal fees of 10 lakhs is paid. On inquiry with management is not revealing, they are evasive, they are not giving details about this. And this is where auditor feels that something is fishy, something is not correct, something is not appropriate. So if he feels that there is a risk out here, okay, and they're saying that we cannot give you, because the work is done by the lawyer, the external lawyer. So what Sunitha, Sunitha, what Sunitha does is, she goes for direct communication with the lawyer. She went for direct communication with the lawyer, directly sends letter and asks for the information. She shoots off the inquiry letter on her letterhead. On her letterhead. Is that appropriate? That is definitely not appropriate. She can draft the letter, it will be printed by the management on their letterhead, they will approve this communication, then she can send it and reply will be directly received by her. She went completely wrong that she's communicating directly without taking, without taking prior approval of the management. Management has appointed that law firm. There's a relationship between management and law firm. So beautiful case, guys. Beautiful case. So very simple, give reference of SA 501, reference of 501, then you explain the step number 2. Step number 2 and litigation claim, and step number 2 is pretty simple. If there is a risk, you go for explain the step of direct communication, letter of inquiry, who does what, discuss the case. She has gone wrong by where she doesn't inform management about it and she uses her own letterhead. There she goes wrong. You explain there she goes wrong, and then you give a conclusion. It is not in compliance with SA 501. Lovely case, beautiful case, lovely case, beautiful case. It's application of the knowledge, guys. It's application of the knowledge. So that's why new study material cases are superb. New study material cases are superb. They are lovely. They are mind blowing. Okay. Now, so guys, we are discussing beautiful cases of SA 500, beautiful case of SA 501, lovely questions, their analysis, their crux and the answer. Then it's pretty simple, straightforward. It has been asked in November 20 exam and now it is there in study material 23. Now it is there in study material 23 and it simply talks about examples, understanding the methods, how to understand the methods used for segment information. You must be aware that in notes to account, we give segment wise breakup. What is the revenue and profit of different business segments? So how to do audit of that segment information is given by SA 501. So segment information, these two things, guys, I think these two things quickly I'm explaining. So in fact, you explain these two things. As an auditor, you should first go and understand the methods which are used for segment information. Understand the methods. First, understand how are they making segments. First go and understand, okay, what is their primary segment? Different businesses is their primary segment. Geographical area, their secondary segment. Okay. Then understand what segments they are making and which businesses which are small they are putting in others. So go and understand their methods. Then how the information is generated. How the information is generated for these segments. Whether information is captured segment wise, and then how common income, common expenses, common assets are distributed. So first understand the method, then evaluate the method. Is it as per? Evaluate the method. Is it as per Ind AS? Is it as per AS and Ind AS? Is it appropriate? Evaluate the method. Test the methods. Okay. So whatever they are saying, go and test it. Whether go and test their methods. If they are saying that we have done is business wise, whether they have covered all the businesses, properly, test the methods. They have applied Ind AS properly, test the methods. Whether the data is coming from the software, test the method. Whether common costs are properly apportioned, test the methods. You test the method. And the audit procedure you use are different. You can use different audit procedure. The most popular is analytical procedure. Compare current year with the previous years and others in the industry. Analytical procedure is going to tell you a lot. is going to tell you a lot whether things are appropriate or not. Okay, you can go for reperformance, recalculation, and so on. You can go for these things also. So guys, it's in sequence. First understand the methods, then evaluate the methods, then test the methods. For testing the methods, you use audit procedures, you use analytical procedures, you can use other procedures like reperformance and recalculation. Then when it comes to understanding, give more points what to understand. So there's a shortcut, intersegment ABC. So first understand how intersegment transactions happen. Sales, transfers, charges between the segments. How this intersegment happens. Is it happening at cost or cost plus profit or market value? How this is happening, and understanding how they are finally eliminated while finalizing the P&L, because in the P&L intersegment sales won't go. So understand about the intersegment transactions and their treatment. Then ABC, understand the allocation, how common costs and common assets are allocated, what's the ratio, what's the proportion, and is it logical and justified. B for compare with the budgets. You will be having the opening budgets that this year this segment is going to do so and so. So go and see whether the budgets and actuals are matching with each other. Then go and see the consistency, compare with the prior period, whether the number of segments are same as compared to prior period. In AS India, there's a principle of continuity principle. There's a continuity principle. Compare with the previous year. So I will say that explain everything. Give reference of 501, understand, evaluate, test. For testing, use audit procedures. Then understand intersegment A, B, C. So 4 points are covered there. So we have covered this also, guys. Beautiful. Again, study material 23, it was asked. We have covered all of them. Now again, this is first time this concept is targeted. This concept was always there, but then they're targeting it first time, and they have again made a beautiful case out of that. Guys, this is a case of SA 505 external confirmation. So what's the case? They have sent a positive confirmation request to 30 creators. 30 creators, all are small creators. 30 creators, 30 suppliers, they are small entities. Responses are received. They have sent requests to 30 and all the responses are received within a week's time. That is pretty impressive. You're getting all the reply. But later on, they observe that, Article Club observes that 25 of these entities GST registration is cancelled, and they have been cancelled during the year, and no fresh registration is done. So that is quite unusual. That is quite unusual that 25 of the entities have cancelled their registration and there is no fresh registration. So that simply means there is a chances of these are the fake bills. These are the fake entities. These are the fake bills. Okay. Now, how would you proceed to deal with the situation? Lovely case, guys, and this is where students may go wrong. They have not pointed anywhere that think about that there's a doubt over reliability of external confirmation. So situation is, you send confirmation request, you got the reply, you got external confirmations, but then you see the unusual thing. You see unusual thing that the registrations are getting cancelled. So you feel that these are the fake entities, and this particular thing creates doubt in your mind. That there is a doubt over reliability of external confirmation. There is doubt over reliability of external confirmation. That is that now interpretation. Anyone must be having all the knowledge, but if he doesn't know what to write in which question, it's useless, guys. Again, beautiful, lovely case to interpret and to apply the knowledge in such a manner. Apply the knowledge in such a manner. Okay. So you have to talk about it. Let's see, guys. Doubt over reliability. Doubt over reliability 505.80. Okay. Now you have to write these four things. Suppose to write. So first thing is you are going to give reference of SA505. Give explain. Then you explain that the concept of doubt over reliability of responses, doubt over reliability of external confirmation. Okay. Four things. First, you are supposed to say that sometimes we may identify the factors, situation that creates doubt over reliability of the external confirmation. Like here, we feel that these are fake entities, these are fake bills, and this fake external confirmation. There is nothing genuine and real about this. What we are supposed to do? We are supposed to obtain further evidence about it. We are supposed to check these external confirmations. We are supposed to get more information. We should talk to them again. We should talk to them on call. We should talk to them on call. We are supposed to know more about these entities. Obtain further audit evidence. Obtain further audit evidence about these responses, about the entities, who are they, get more and more details so that you are able to conclude whether these confirmations are reliable or not. Are they genuine? Are they real? If you see these are fake confirmations, there's a fake things going on, then you say that it's not reliable, then there's a big shock that external confirmation not reliable. Immediately, we'll have to increase risk of material misstatement of that area. In our case, about creditors, about RM, and if you think that it is intentionally done, increase the risk of fraud also. Once you increase the risk, we are supposed to adjust NT, we are supposed to adjust increase nature, timing, extent of audit procedure. So you're supposed to explain these four things. If there's a doubt over reliability, and they're logically connected, if there's a doubt, we go for further, or we should go for further evidence to find out about the reliability. If they're not reliable, increase RMM, increase fraud risk, adjust nature, timing, extent of audit procedures. These are the four things we are supposed to do. Here exactly those four things. Then discuss the case, give reference of 505, discuss the concept, discuss the case, and say that there's a doubt over the reliability, and we should perform more procedures. We should increase the risk levels and perform more audit procedures in this area. This can be a classic case of fake bills. We all know that it's pretty popular in India. Okay, pretty popular in India. Roshan, we are going to start Inter's Param batch from 20th. 20th, around 20th, we are going to start, and we are going to cover important questions there also. Okay. Now, let's go to the next question, guys. Let's go to the next question, guys. Again, lovely, there's a refusal. Don't go and send don't go and send. It's repeated n number of times. So management says that please don't send external confirmation request to so and so party because a dispute is going on. As an auditor, what will you do about it? As an auditor, what will you do about it? 505.100. Very simple, 3 steps. Step number 1, we are going to do inquiry. What are the reasons why we should not go for external confirmation from these parties? What's the reason? Okay, dispute is going on, and and in this dispute, a lot of discussions are going on right now. We are trying to resolve the matter. This particular communication can complicate the thing, so please don't go for it. So they say, please don't go for it. Don't put this request to the daters. We will lose money. So go and understand the reason. look for the evidences. If you're really that, if that is the, if you feel if that is the case, look for the evidences, whether evidences supporting these reasons. Then step number 2, if that is true, sit and understand, were you expecting it? If you're not expecting it, increase the risk of material misstatement. If you think it's intentionally done with you, increase the risk of fraud and increase nature, timing, extent of audit procedures. Step number 3, you go for alternative audit procedures. You try to get evidence from the alternative sources. If even then if you're not able to get it, go to TCWG. Okay, if you feel that reasons are unreasonable, or if you're unable to get sufficient appropriate evidence, go to TCWG about it. That listen, it's not acceptable, and there's a lack of evidence, unable to obtain sufficient appropriate evidence, take effect on auditor's opinion. So 3 steps: inquire about the reasons, see the evidences, then evaluate, increase the risk, increase NTE. Go and perform alternative procedures. Go to TCWG if you feel reasons are unreasonable, or if you feel that you're not getting sufficient appropriate evidence, you go and modify the opinion. Perform 3 steps. It is pretty simple and straightforward, guys. If there's a refusal from their side, come on, guys. Lovely, beautiful cases, lovely interpretations, lovely concepts are there. Okay, now SF501, SF510 opening balances, pretty simple, straightforward. They're simply asking what is initial audit engagement. How to check opening balances, in the case of initial audit engagement, audit procedures. Okay, and there can be situation that no audit was there in the previous year, or someone else did the audit. Audit procedure remains same. It doesn't have any impact, any change. And they're further asking what to do if you're not satisfied about the correctness. If you feel that balances are not appropriate, what to do? They're asking that also. So they're asking, what do you mean by initial audit engagement? Then they're asking, what are the audit procedure you should perform? What if you're not happy and satisfied? Then next, they are simply asking, state the steps you would like to ensure that the closing balance of the previous have been brought forward as opening balances. Okay, how to check whether opening balances are having misstatement or not? Guys, you need to be sharp and understand, okay, again I have to answer this situation as per SF501, SF510, sorry. I am again as per SF510. So simply, first simply explain what is initial audit engagement. If no, you have to go and see immediately preceding year. If no audit was conducted in the previous year, or there was a different predecessor auditor in the previous year, then by someone else, then it's called as initial audit engagement. Audit procedures are pretty simple, guys. Okay. So first we have to check whether opening balance is misstated. I have divided it in 3 parts. Evidence which is coming from last year, then B, evidence which is coming from the current year, and C, what to do when misstatement is detected. Let's understand, guys, very simple. Evidence which is coming from last year. Simply go and take last year's ledger and check whether closing balances of last year ledger has been properly carried forward as opening balance in the current year. Go and match it. So this is the evidence coming from the last year. Then go and obtain last year's financial statement. And see whether balances of financial statement match with opening balance. Then next, go and obtain, if available, last year's audit report and read it. What is it saying? What is it saying about the closing balances, which are our opening balances? Whether it is giving clean opinion or whether there is a modified opinion. If there is a modified opinion, whatever are the items of modification, mark them as high risk of material misstatement, because there is a misstatement, there can be more misstatement. If any prior period item is coming, if there is a mistake of previous year and it is being rectified in the current year, go and understand what this prior period item is all about, what was the mistake and how it is rectified. So 4 things are coming from last year. closing, take last year's ledger, whether closing is becoming opening, take last year financial statement, whether balances are matching, take last year audit report, read it carefully, it is unmodified or modified, and then prior details about the prior period item. Then lot of evidence is coming from current year. Current year audit procedures can give you loads of evidence about the opening balances, loads of evidence. In fixed assets, investments, inventory, when you see that there is a fixed asset, there is an investment inventory, you can see, you can confirm, yes, they are real. And when you see that date of acquisition is before 1st of April, it gives you evidence that, okay, they existed in the opening balance. They existed in the opening balance. Then recovery of current year debtors. Then when you see that in the start of the year, opening debtors are recovered, opening creditors are paid, that again gives a lot of evidence about the opening balance. So current year audit procedures automatically are going to give you loads of evidence about the opening balances. If required, you can perform specific audit procedures. You can perform specific audit procedures. Okay, you can go and compare with the previous year. You can go and perform reconciliations as required. If a misstatement, if there's a possible misstatement or misstatement is detected, we can go and perform any number of audit procedures, any depth, any number of documents, any number of inquiry, any number of calculation we want now, because it's a matter of a misstatement. So okay, we can do as we want. And if we come across misstatement, we'll ask for its rectification. We will ask for its rectification as per concepts of SA 450. As per concepts of SA 450. Okay. Then finally, we are also supposed to consistency of accounting policy, read previous year accounting policy, current year accounting policy, compare them, inquire about them. If there is a change, then change should be justified. It should be properly accounted, presented, and disclosed. Let's freeze, guys. This is how you remember things. That if you want to check opening balance, some evidence is coming from last year, some evidence is coming from current year, and what if there is a misstatement? Then you talk about the consistency of accounting policy also. So, guys, it was lovely. The way the flow is, okay. Then they're talking about this. What if there is no change in the opening balance? What if there is no change in the opening balance? First audit assignment. So it is an initial audit engagement. Initial audit engagement is doing audit for the first time, and while checking opening balances, while checking balances, he has left out rupees 150 lakhs. There is an account receivable. There is an account receivable of 150 lakhs. He has checked. When he is checking balance sheet items, there is a 150 lakhs. 150 lakhs is coming as it is from the opening balance. There is no change at all. Management is affirming there is no change at all. Excluded from the audit program the audit of account receivable on the understand that it pertains to preceding year, and as already it pertains to preceding year and already audited by the predecessor auditor. It's very lovely and very, very beautiful again that this is the initial audit engagement, and in this initial audit engagement, he sees that there is a balance of 150 lakhs. It is as it is, no change at all. Management is saying there is no change. We affirm, we give you a written representation. There is no change. No need to check it. It is as it is. There is no changes at all. So auditor says, okay, if there is no change, there is nothing to check about it. There is no change. There is no accounting entry. There is nothing to check about it. Okay, that's absolutely wrong approach. Has been asked in May 20 mock paper. It's not a correct approach. It is not a proper approach. Okay. So first they're explaining, it is an initial audit engagement. And initial audit engagement is responsibility to check opening balance, whether there are material misstatements and consistency of accounting policy. Okay. So you explain the objective. So you explain the objective, okay, and then you can explain in short. See, guys, these are nothing but our audit procedures only, which we have just discussed. Which we have just discussed. There are evidences coming from last year, evidences coming from current year, and what if there's a uh, possibility of misstatement? We have discussed this just now. So you give reference of 501, you explain the objectives, you explain the audit procedures, and in addition, as per SA 580, okay, we can take written representation also. Written representation also about the, we can take, no problem, but then we can take written representation, but then be careful. Written representation cannot substitute any audit procedure, it is cannot substitute any audit evidence. It is not a primary evidence, it supports other evidences. So give reference of 501, explain the objectives, explain the audit procedures. Then come to 580, explain, it cannot substitute. Then you discuss the case out here. And then you say that approach of the auditor is not correct. Though there are no transactions, a lot of different things can happen. There may be heavy impact on the recoverability of the balance. Maybe the balance is not recoverable, maybe a write-off is required, maybe a provision is required. Only because the balance has not changed, that means not to check it is a not correct approach at all. Because a write-off may be required, provision may be required, there can be dispute in it, there can be fraud in it, a lot of wrong things can be there. So should not exclude. So this approach is not appropriate. And further, it being an initial audit engagement, checking opening balance is a part of the program. He is not working with due diligence. It's a gross negligence if you're not checking such balances. So guys, I will say that the overall content is same. So again, you go for the objective, you explain the procedures, you discuss the case, but then in conclusion, you say clearly and cleverly that listen, this approach is not appropriate. And you give the reason. Because even if there are no transaction, situation, circumstance change, recoverability can change, and it is our responsibility to check opening balances. How can we leave it from the program? It is our responsibility to check the opening balances. Okay, we cannot leave it from the program. It will be gross negligence. Now guys, let's go next. It is asked in study material 23. Mr. Hussain is appointed as auditor for the year 22-23 on 31st July 22. The accounts of firm were audited. Previous year is unaudited. He is performing the audit procedure, including attending physical verification. Doubt over the opening inventory. Does there exist any responsibility on his part in such situation? So basically, he is having, it's a initial, last year no audit was done, it's an initial audit engagement, there's a doubt over the opening inventory. Is he supposed to go and perform anything about it? Because something is wrong in the opening balance which is coming from previous year, something is not wrong in the current year. He is supposed to go and check. Again give reference of 501, 510. Again give reference of 510, explain the objective, explain the audit procedures, and then you explain that. Okay, and then you explain that whenever there is a possibility of misstatement, whenever a misstatement is detected, misstatement is detected, we go and increase our audit procedures. Okay, so we will definitely go and check this. Which is within our scope. SA 510 says that you have to check it, perform any kind of audit procedure, any kind of details. So they are explaining what specific audit procedures you can perform. There can be a reconciliation. What you can do is you prepare opening plus purchase minus sale is equal to closing. You can get opening balance as a reconciliation. Okay, you can check valuation of the opening inventory. You can simply have one more analysis. If you have a gross profit, you prepare a trading account. You know that this is the gross profit these guys have. Put the gross profit. Again, you will get opening balance as a balancing figure. Opening balance as a balancing figure. You can go and check the cutoff also. Cutoff, whether uh, whether the opening cutoff and closing cutoff is appropriate. There are specific audit procedures which you can perform. So first explain the standard, objective, they explain the procedure, and there's yes, whether there's a possibility of misstatement or misstatement detected, we go for more audit procedure, whatever we feel is appropriate. It doesn't matter even if it's coming from the previous year or prior year period. We have to check it because opening balance is within our objective, within our scope, and they are giving the procedures for that. Again, lovely question, guys. So finally, we are through with chapter number 5. Finally, we are through with chapter number 5. With this, guys, we are through with chapter number 5. So that's a good achievement, guys. We are through with chapter number 5 in this particular lecture. Lot of beautiful, lovely questions were there. A lot of lovely answers were there. And in exam scenario, in exam situation, these questions become difficult. Okay, sorry. We are, sorry, you're not yet through with the chapter. Sorry. We are not yet through with the chapter. There are more things out here. Okay. I am generally very ambitious. I think this will be done, that will be done. And then I realize that, okay, so much things are not happening, not possible. That's fine, guys. But you should always aim high. You should try to achieve more and more things. Okay. Now let's see, guys. So now there are questions of SA 530. It is yet to get over. Questions of 530, that is about sampling risk. Quickly, it's pretty simple. Chances that conclusion obtained from the sampling process is not the conclusion which you can obtain from 100% checking, or it is not representing the truth about the population. That's called sampling risk. Okay. Now, because of sampling risk, two types of error can happen. You first explain that because of sampling process, the conclusions are going wrong. Chances that conclusions of sampling process are inappropriate. They are not representing the reality. They are not representing the population. They are not representing the conclusion which you can obtain from 100% checking. That is sampling risk. Then you explain that. Because of sampling risk, two types of error can happen. Type 1 error and type 2 error. What is type 1, type 2? In type 1 error, you after doing sampling, you feel that everything is good, everything is lovely, everything is proper. There are no issues, no problems at all. In test of controls, you feel controls are operating reliably, controls are very good. Okay. In test of details, you feel that financial items are not having material misstatements. You can accept you are accepting the financial statement as appropriate. There are no material misstatements. But then, guys, this is happening because of type 1 error. This is happening because of sampling error. In reality, controls are not that reliable. In reality, there are material misstatements in the population. So because of sampling risk, there can be type 1 error. Type 1 error means in sampling, we feel that everything is going all good. We feel controls are very good. Okay. But then this is because of error. This is because of error. And because of this error, there's an over-reliance on control. Controls are not that great. Because of this error, in test of details, there is incorrect acceptance. We are accepting everything good. Incorrect acceptance. Type 1 error is very dangerous because we feel everything is good. When we feel everything is good, we move on to the next item. And in the process, we may miss the material misstatements present. Which are present. we may miss material misstatements, our opinion can go wrong, quality of the audit is deteriorated, quality of the audit gets affected, quality of the audit gets affected. Then we have type 2 error. Now, because of sampling risk, type 2 error can happen. What happens in type 2 error? In type 2 error, we feel that everything is bad, everything is wrong. We feel that in test of controls, controls are bad, controls are not reliable. In test of details, we keep on rejecting financial items, transaction balance disclosure are not appropriate, we keep rejecting that. But then this is happening because of error. This is happening because of error. In reality, controls are good. In reality, there is no material mistake in population. This is happening because of error. Because of this, we may spend a lot of time in checking, loads and loads and loads of time in checking, because we think that there are issues, there are problems. But at the end, we will realize there were no issues. Because of type 2 error, we do a lot of hard work when it was not required. It affects efficiency of audit. Type 1 affects effectiveness of audit. Type 2 affects efficiency of audit. So explain what is sampling risk. Explain there are two types of error. Because of these errors, we have different opinion. And because of that, there are different issues. Because of type 1 error, our opinion can go wrong. It affects quality of audit, effectiveness of audit. Because of type 2, we may do more and more audit when it was not required. We may waste our time. It affects efficiency. So explain about this. A pretty famous question. Okay, so there's a study material question. And it is on sampling risk. Okay, so there's a chartered accountant, Mr. Ritesh Deshpande, and he reaches a conclusion, and it is a erroneous conclusion that controls on application are less effective. So he's doing sampling. He's doing sampling for test of controls and test of details, and he is going to conclusions. He is thinking that controls are less reliable. Controls are not reliable. And that is a erroneous. Because of sampling risk, error can happen, and because of that error, he is feeling that controls are not reliable, they are not good. Further, he is checking work in progress in inventory, and he feel that there is a material misstatement in work in progress in inventory. In test of control, he is feeling that controls are not reliable. In test of details, he is feeling that there is a material misstatement. And this is happening because of error. So you need to explain it's a type 2 error. In type 2 error, we feel that controls are not reliable. So that is application of knowledge, guys. So we feel that controls are not reliable. Controls are not at all reliable. Okay. And we feel that there are material misstatements. Two things are happening. Okay. So this is a type 2 error. Because of error, we are not relying on controls. Because of error, we feel there's a material misstatement. As the auditor will increase loads and loads of efforts, work hard to find out the truth, and we may realize that it was just an error. There is no such reality. So it will result in wastage of resources. It is going to affect efficiency of audit. So you were supposed to explain that it is a type 2 error. You're supposed to explain it's a type 2 error, and it's going to affect efficiency of audit. It's the application of knowledge, guys. Now, lovely. It was asked in November 22 RTP, and then study material 23. Okay. So they are discussing about the sampling process. It has been asked in November 22 RTP, study material 23. Very hot and very important question which can come up. Guys. So Chintan is concerned about whether the use of audit sampling has provided a reasonable basis for conclusion. Whether use of audit sampling has provided reasonable basis for conclusions about the population that has been tested. about the population that has been tested, you are required to guide Chintan about his role, or its sampling has not provided reasonable basis. Okay guys, so now listen. So in the sampling process, in sampling process guys, in sampling process, there are 7 steps. There are 7 steps in sampling process, and the seventh step is evaluating the results, studying, examining, analyzing the results. Studying, examine, analyzing the results of sampling. In step number 6, we make the projections, that this is the projected rate of deviation in controls. This is the failure rate in control, deviation rate. And this is the projected material misstatement in case of test of details. So in test of controls, we get the projected rate of deviation. In test of controls, we get projected rate of deviation. In test of details, we get projected material misstatement. In step number 7, we are supposed to evaluate it. So basically, what we do, we compare the projected amounts with the expected amounts and the tolerable amounts. We compare with them. Okay. So once we get the projected things, we are supposed to evaluate it. We are supposed to evaluate the results of sampling. We are supposed to find out, is it giving us confident, is it giving us reasonable basis, strong evidence, confident evidence or not. Okay. So basically for this, we compare projected rate of deviation with, suppose we get that the projected rates of deviation or projected material misstatement is much below the expectation and much below the tolerable rate, is much below that, then we get very confident, we have confident evidence, we have strong evidence, we have reasonable basis to say that everything is fine. And if it is convincingly crossing the expected limits also and tolerable limits also, again we convincingly say that controls are not reliable, there is or in test of details there is a material misstatement. So we compare. But sometimes there is a confusion. Projected rate was 10%. Okay. Expected was only 8% and tolerable was 15%. Sometimes projection is beyond expectations but below tolerable. And now we get stuck out here. This is a stage of confusion. Generally, we have to compare our projected things with the expected and tolerable. Let me tell you, just before performing sampling as per the past experience, present circumstances, and after doing some checking, we compute expected things. That as per our experience and analysis, what should be the expected rate of deviation, what should be expected material misstatement. Okay. Now, if projected falls here, there is a stage of confusion. Why is the stage of confusion? Because projected is beyond expected. That means our expectations are going wrong somewhere, our understanding and knowledge is wrong somewhere, but it is still below tolerable. So it is within control. What to do in this scenario? In this scenario, we say that sampling results are not providing us strong, confident, clear results, whether to rely on them or not. We'll call management, do inquiry from them. How come our expectations are not correct? How come our expectations are going wrong? Please explain, because you gave all the information explanation. We saw the evidence and as per that we did this. How come our expectations are going wrong? We'll do inquiry, we'll investigate. We'll ask management to investigate into matter how this is happening. how this is happening, you go and investigate it, go and check the area, and then we may go for resampling, may go for higher sample size, we may go for more nature time extent of further audit procedures to further audit procedures, okay, so as to find out, to get better sampling results, okay. Let's freeze, guys. I'm not going in detail. Let's freeze. So in seventh step, we have to analyze the results, and we have to analyze the sampling results, and we have to find out, is it giving us reasonable basis, strong evidence, confident evidence? And basically we compare these three things. If projections are extremely low or extremely high, we have a confident, straightforward result. But if they fall between the expectation tolerable, it is a stage of confusion. We call management, we talk to them, we understand, we ask them to investigate, go back. And so we ask management to go and investigate, find out how this is happening, give us the reasons. On the other hand, so we ask management to do something and we start doing it. We go for revised, we go for resampling, bigger sample size, more audit procedures, and let's try to find out the truth. What is the truth? And after performing that, we may get that projected levels are extremely low or extremely high, then we are able to make strong conclusions, okay. So if there's a stage of confusion, you have to redo it. And sir, what if it continues? Listen, we always, when stage of confusion happen, we always are conservative. We assume that controls are not reliable, there is a material misstatement, unless new audit procedures, resampling gives us some other evidence. So we go conservative. Let's freeze, guys. We talk about step number 7. We say that we have to evaluate the results and we have to find out whether reasonable basis or not. We basically compare three things. If there's a stage of confusion, we ask management to do things, we ourselves do things, and we take a conservative assumption till that things are not good till the time we get more evidence to prove anything. So you will explain about evaluation of results. Then you will explain that we have to evaluate the results. We have to find out whether there is reasonable. Okay, guys, there was a lag in between, and now we are back. Let's see. We go to, so finally we are finishing off chapter number. We had a target, we have very ambitious target, but I'm realizing that may not be possible when it comes to standards on auditing. That may not be possible. There are always some issues, challenges, complications involved in that. So we come to related parties, and they're simply asking that when you go to audit and you are checking related parties, there are chances that people will hide related party relationships and related party transactions. They may hide related party relationship and transactions. What are the different documents which give you information about related party relationships and documents? How will you check existence of related party transactions? So if you come to know, how will you check existence? Or what are the possible sources of related party information? Possible sources of related party, or what kind of records and documentation? What kind of records and documentation you should go and see? What kind of documentation and records you want to go and see? Let's see, guys. So this is 550.60. We have arranged this beautifully so that it is easy. We have arranged it beautifully so that it's easy to understand and retain and remember. Okay. Let's see, guys. Let's see, guys. So they are giving us list of. They are giving us. They are simply giving us. They are simply giving us a list of documents. So first they are giving list of mandatory documents, then they are giving list of the documents which they may get. We may take mandatory documents. Go for external confirmation. Talk to banks. Go for external confirmation. Talk to banks. With which parties there heavy transaction, or with these related parties what are the transactions. You can get loads of information about relationships and transactions. Talk to BAM, take external confirmations from them. Talk to lawyers with whom we have a lot of contracts. Take external confirmation from them. Talk to directors, third parties, directors maybe, in which other company you have invested loads of money. Take confirmation from banks, lawyers, third parties. Go and read the minutes of audit committee, minutes of board of directors, minutes of shareholders. You may get information about related party relationships and transactions. Any other important documents like restructuring, amalgamation, merger, demerger, it's mandatory to go for external confirmations, mandatory to go for the minutes, and there can be some other crucial documents you should go for it, like reconstructions and all. If there's a big change, now which we may go for it. So first we should go for 3 types of documents. Then we may go for more documents. So we have arranged it. We have arranged it in a flow. We have arranged it in a flow. There are some documents which are law related. Then, so the biggest thing is law. Below that, contract. Below that, shareholders. Below that, directors. Below that, professionals. Below that, subsidiaries and associates. Okay, let's understand, guys. So law related, first we go for law related things. Okay, now what is this law related thing, guys? Let's understand. It's pretty simple, straightforward. Okay, law related. So as per section 199, we are supposed to a company is supposed to maintain related party register, their details, their contracts, their transaction, their balances. That is a good source of information. Then we have to send it to SEBI, SEC, tax authorities about related party. We need to do filing. That is a good source of information. And then contract. If the contracts are renegotiated again, then there can be related party connection. If contract is not in ordinary course of business, there can be related party connection. Go and see shareholder register. Our big investors are our related party. Go and see directors registers. All the directors are related party, and wherever they've invested, they're related party. Then for transaction with directors, go and see contracts with them. They are all related party transaction. Go and see insurance policies for them, pension plan for them. Go and see statement of conflict of interest. That's all part here only. Okay. Now, statement of conflict of interest. Wherever there is a statement of conflict of interest, then we will understand. Okay, these are the parties in which director is involved. This can be, again, can be a source of related party transactions. Go and see professionals report, internal audit report, invoices. You may get the related party related transaction. Subsidiaries. See investment register. See investment register of the subsidiary. Wherever they have investment, they may become related party. So guys, some documents are mandatory, some documents are raw related, 2 documents, contract related 2 things, shareholder related, direct related things, then professional related 2 things, then subsidiary and associate. This is the best way to remember the big list. This is the best way to remember, because generally students get panic how to remember so much. Now, next we have what if. Now this is in study material 23. Study material 23. And it's this lovely question again. There's a lovely question again. So there is a Living Well Private Limited. Living Well Private Limited is engaged in manufacturing exports of floor coverings. Manufacturing and export of floor coverings, which is labor intensive, which is quite a labor intensive work. The company has no plan to diversify in other product. Its directors also significant interest. So directors are having significant interest in another company, My Living Private Limited. So there are Living and My Living, 2 companies. Okay. There are directors having their directors controlling both of them. Their directors controlling both of them. So there's basically a common control. There's a common control. That means these two parties are related with each other. Now the second company is involved in manufacturing of blankets, which is quite capital intensive. So one company is doing labor intensive work and another company is doing capital intensive work. One is into floor coverings and one is into blankets. During the course of audit, My Living has noticed it was noticed that company has sold machinery of 1 crore to Living Private Limited during the year. The transaction has been done at normal market rates applicable to such machinery. It's at normal market price. How do you view the above transaction for My Living Private Limited? For My Living Private Limited. Now understand this, guys. So one is a labor intensive and one is capital intensive. A capital intensive company is selling a machinery to a labor intensive company. That is quite unusual. That is quite unusual. First of all, why should I sell my machinery? I need machinery myself. And why it is being sold to a labor intensive company? It is not a normal transaction. It is called outside normal course of business. Guys, the most important thing is interpreting it in exam environment. First of all, you need to understand both are related parties. Both are related parties, and next you're supposed to understand, and in this, both are related parties and outside normal course of business, something which generally doesn't happen in the industry, unusual thing is happening. So two things are happening together. It is a related party transaction and it is outside normal course of business, which generally should not happen. What are we supposed to do in this? See guys, I will give you a beautiful shortcut. Okay. So if you come across significant related party transaction which is outside normal course of business, we have 4 audit procedures to be done. 4 things we need to check. The shortcut is you should, first of all, this combination leads to significant risk. If these two things happen together, it is a significant risk. Because first of all, it is a related party and it's outside normal course of business. This combination itself is significant risk. And if there's significant risk, you need to have a special consideration. You need to have a special audit procedure to check it. We are supposed to perform 4. The shortcut is, so if this is the situation, apply AIR approach. Simple. Apply AIR approach. If this is a risky situation, apply AIR approach. Okay. A stands for authorization. We're supposed to check whether these transactions were authorized by the seniors, by proper authority, whether the seniors and appropriate authority are aware that such things are happening. Authorization. Inspection. Go and obtain all the contracts, underlying contracts, agreements. Go and read it. What is the contract agreements? What is the written? What is the, okay, go and read it. Read all the contract agreements and documents. Very important are rational. What is the business rationale? Why it is being done? Why a labor intensive company is buying it? Why the hell are they buying this why the hell are they buying this machine? What is the business rationale? Suggest prudential for reporting asset misappropriation. Okay. Understand the rationale, understand the logic. See what management is saying and whether whatever management is saying and documents and circumstances, are they supporting it? Or otherwise, it can be a fraudulent transaction. It can be fraudulent financial reporting. It can be misappropriation also. See, sometimes it may be justified. that the other company wants to do something new, it may be justified. But then here in question, they're saying that they are not planning to diversify, they're not planning to do anything. Why they are doing so? It can be a fraudulent financial reporting. The company selling it wants to show profits. That may be the reason. Or a misappropriation is happening from one company to another company. So look at the rationale, whether it is matching with the documents, and finally accounting. See whether it is properly accounted for. What is the actual price, how it is accounted, how profit is shown, what is the nature of profit, how it is present, whether it's properly accounted, whether it is presented and disclosed. So if these two things come together, we need AIR approach. We need to see authorization. First comes authorization, then come inspection of documents and contracts, agreements, then we look for the rationale, and then we look for the accounting. Extremely important, guys. The way question is drafted is lovely. The way question is drafted is lovely, is beautiful, next level. So guys, we are through with that. We have finished one more chapter today. We have finished one more chapter today, guys. And we have seen lovely questions. We have seen lovely explanations and discussions. Guys. We'll stop here. Okay, bye-bye, everyone. Do put your lovely comments. I really love to read the comments. Please do put those comments.